Where do you see the best opportunity in emerging markets when we're going to see, it looks like, a global rate cuts like we saw with Russia today?
You know, overall, we allocate to emerging markets. We allocate not to the index, but to actively managed strategies. Our portfolio managers in those strategies are underweight China at the moment, but overweight countries in Latin America. The big picture, as you just mentioned, is that there's room for rates to come down in emerging markets. Central banks have more bullets. We were just talking about China, the ability of China to stimulate. The country is already stimulating its economy. The goal, though, is not the same as in previous measures. The goal here is to stabilize growth at 6.5%. It's not a bazooka, but we could see a little bit more, which would be a bad news is good news kind of event, perhaps, for equities.
So, Denise, you point out in your notes that emerging market debt has done pretty well over the last 15 years, actually, much better than the global debt market has done. As you look right now in a world of slowing global growth, which looks like where we're going right now, where does that create opportunities when it comes to emerging market debt?
I think, again, you want to focus on dollar-denominated credit, because there, the risk premium you're getting, the yields, which right now are around, let's say, 5.5% to 7%, are quite attractive because default rates have been very low in emerging market sovereigns.
Sovereign, dollar-denominated debt, or private?
I think both. I think sovereign and corporate debt look attractive here.
What kind of countries?
I think you want to stick with countries that have stable macroeconomic outlooks. I think a lot of those countries are in Asia, in the investment grade sector, some in Europe, Latin America.
How hard is it to find, though, those countries that are limited exposure to trade? Because in Asia, for example, if China's hit by trade, if their data rolls over, it's going to trickle down to the rest of the region. So how do you find ones that are more isolated?
Well, I think, when you look at, when the countries that are exposed to trade, there you want to, the FX is going to be more vulnerable. But I think the dollar-denominated debt has a different dynamic. The balance sheets in these countries are quite resilient. Debt to GDP is low, so they are vulnerable to that over time. But they're not. The debt's not at risk there. As
you sort through these possible investment opportunities, which is more important? Things like how exposed are they to trade on the one hand, or more structural factors like debt to GDP ratio, inflation rate, things like that? What's the dashboard that you use?
Right. Well, I think over the medium term, I look at the balance sheet and how resilient that will be over time to different shocks, both domestic and external. And in the shorter term, look at global factors in the growth outlook, and how, in particular, how that's going to affect some of the assets that are more sensitive to the short-term factors, like currencies, which are more globally sensitive.